I'm Rob Kingsbury. I'm here today with Ian Lowes, founder of CompareStructuredProducts.com and the Managing Director of Independent Financial Advisors, Lowes Financial Management. Ian, I think it's always a good idea when you've got this kind of investment to summarise the pros and cons. Could you go through the benefits and then maybe the disadvantages of structured products to tie up our sessions?
Okay, it's going to be a summary because obviously there's a huge range of different types of structured products and most of them have different benefits and different downsides. Essentially, the main benefit that I think of structured products is that they give you those defined outcomes. You have defined returns linked to that defined underlying measurement and delivered at a defined date. That means that you know what you're going to get in certain market circumstances. That can assist in capital gains tax planning or other tax planning. For example, that you may have investments that potentially mature in year 3, year 4, year 5, year 6. If you want to realise gains from the rest of your portfolio, you can do so in year 7. And of course, everybody has this capital gains tax allowance of £10,000 odd each year, which gains up to that amount are tax-free. Any gains in excess of that currently taxed at 18% for basic rate taxpayer, 28% for higher rate taxpayer. So the tax planning, the defined outcomes, the majority of structured products can produce a positive return in flat or just slightly rising markets. Some of them can produce a gain even if the market has fallen. For example, there's a contract out at the moment which is going to give you a potential for a 60% gain even if the market has fallen by 20%. Obviously, I caveat all of this in that you're taking counterparty risk and you're investing for the full 5 or 6 or however many years. Some of them that will give you geared participation or accelerated participation in the stock market or the underlying index can be very attractive. You're going to pay a price for all of this somewhere along the line. The acceptance of risk is one, whether that be counterparty risk or investing for the term. It might be that you have accelerated performance in the stock market subject to a maximum gain on the contract of, say, 75%. Now, if the stock market's gone up by 150%, you could be disappointed. But really, you've got to consider that at the point when you're investing and not at the time of maturity. If you wanted to get 150% or 150% gain in the market, you need to take more risk. And it's all about a trade-off. So structured products need to be considered in the context of other investments and how they all bolt together. But I find that when we talk to clients about them and we see the types of returns that we can get, and very often, not always, and past performance is not a guide, we have structured products that mature giving significant outperformance compared to, say, cautious managed funds or equity income funds. And that's despite the fact that they've had a great degree of protection. So there's all sorts of benefits. On the downside, recognise the fact, everybody brings it up, the FTSE 100 index does not include an allowance for dividends. Now, you are trading away that allowance for dividends. Let's take the contract I have mentioned several times, 60% gain at the end of 5 years, or an order call that's going to give you a 10% on the first anniversary that the FTSE is higher. You're not going to get any benefit for dividends, but nobody mentioned dividends. We mentioned a 60% return if the FTSE is higher. Now, if the FTSE goes up by 1% over that 6 or 5 year period, then the dividends are going to account for perhaps 20% of growth in a tracker fund in that circumstance. You haven't got that 20%, but you've got 60%. Now, if the market goes down, let's just say at the end of that 5 years, the FTSE's 1% down, and the stock market has gone sideways, then the dividends would have played a part because your tracker fund might be up at 119%, your structured product's simply returning your capital. It's a trade-off. You're trading off that potential for the fixed return against the dividends, because what if the stock market was down by 40%? The structured product will return your capital, the tracker fund would suffer a loss, reduced a little bit by the dividends that have been received. So there's a lot of things to bear in mind, but ultimately it's at the time of the investment, look at the terms of the contract, consider that return in the context of how you feel about the markets at the time that you're investing and the returns that you would expect to get from other investments. And you're never going to get it right all of the time. You're going to have to consider diversifying your portfolio, but as I say, structured products can represent a significantly beneficial element to a portfolio.
Okay, that's talking about the sort of the benefits and the pros, if you like. Let's move on to the disadvantages, because all investments have disadvantages. I mean, one of the areas that strikes home to most investors are the charges they pay. How do the charges work within the structured product?
A lot of people suggest that the charges on structured products are very high. Now, some of the bank and building society sold contracts that we've seen have had charges of up to 10% deducted upfront when you invest. If you're buying an investment that is distributed through an independent financial advisor, then obviously that independent financial advisor, who is acting as an agent of the client, has to find the best investments for that particular client. And the higher the charges on that contract, the less competitive it is going to be. And so an alternative contract might come out as being a better bet. But if we take a unit trust as an alternative example, let's take the typical initial charge on an open-ended investment company or a unit trust of 5%. The fund manager might then charge 1.5% as an annual management charge. So we add all of those up, and at the end of, let's say, a 5-year period, we have total charges of 12.5% in very simple terms. A structured product, which is a 5-year investment, will have an initial charge which is deducted, in the same way the open-ended investment company charge is deducted. Currently, those initial charges range from somewhere between 4.5% to about 7.5%. So the charges on structured products are in fact less than your typical open-ended investment company. Now, you can get discounts on the initial charges, and you can get rebates on some of the annual management charges on your open-ended investment companies, but you can also do that on your structured products. So ultimately, when you see a structured product and it says that it's going to give you X on Y date, given whatever performance in the index, that is all after charges. Whereas your unit trust, the charges are going to have an effect on performance. That's not to say that the charges don't have an effect on the performance of a structured product, because if there were no charges, the potential return of being, let's just say, a 10% order call might have been an 11% order call. But the charges are all taken into account before the terms of the contract are put on the front of the literature.
Okay, here's a litmus test question now. Lowe's Financial Management's been researching and recommending structured products since the 1990s. Do you have structured products in your own portfolio?
I have more structured products in my portfolio than I would usually recommend to a client. I carry around about 50% of my portfolio in structured products. I invest in them as and when another one matures. I can choose whether to go into my portfolio of funds or to add to another structured product. I find the defined nature of the returns a very attractive proposition. I would much rather leave my money on deposit and earn significant returns, but I accept that I'm going to have to take equity risk, and I'm an investor, so I'm going to take some risks with a view to achieving greater returns. My most recent maturity produced a 7% gain after 12 months. It was never going to produce any more than that. It produced that. It was a HSBC-backed contract, which matured on the first anniversary because the FTSE was higher. Now, the coupon on this, the potential return, was only ever going to be 7%. I was only going to lose money if the index was down on every anniversary and 50% lower at the end, or if HSBC went bust. So I felt that I wasn't taking a significant amount of risk. That lack of significant risk translated to just a 7% coupon. The FTSE was up 0.03% at the end of 12 months. This was a few points higher, which meant that I got my 7% gain. It was an acceptable return for the risk I was taking. Other contracts in my portfolio carry more risk and therefore potentially give me more return. I also have some structured products which are going to mature at a loss and have had them in the past. In the same way that I have mutual funds, some of which do well and some of which don't do so well. So it's about diversification. But yes, I carry more structured products in my portfolio than I would usually recommend. I have a diverse range of counterparties and a diverse range of payoff profiles.
So overall, structured products, something every investor should take a look at, research carefully, make a decision as to whether they actually fit or are suitable for their own needs.
I think if you're an investor, you should look at everything that's available. Structured products are not going to be right for everyone, but I would suggest that some structured products are definite appeal to certain investors, others to other types of investors. A structured deposit, for example, as part of a deposit portfolio, they could give you, for sacrificing the interest that you would have earned on a fixed rate investment or fixed rate deposit, they could give you a potentially higher return. You're taking interest rate risk because you might not get, so you're taking a risk that you might not get a return, so you've got inflation risk. But at that level, it's at the very low risk, up to £85,000, you're risking the interest alone. assuming you're prepared to take the time commitment. Moving up the risk scale, you can get right up to structured products that are linked. We've seen one that was linked to cotton, corn, and sugar and soya and things. You know, a little bit esoteric for me. We did look at it, but then read the Telegraph, and it told me that cotton was at the highest price since the end of the American Civil War, so we thought that was perhaps not one for us. But certainly the FTSE 100 linked contracts, if you are an investor and therefore you are prepared to take risk, then I would definitely consider looking at some of the structured products that are available. The returns that are on offer on a lot of them surprise some people. As I say, you get nothing without risk, but in a lot of cases they do outperform other investments.
Ian, thank you very much indeed for these sessions. Hopefully that's enlightened quite a few of our viewers here, and thank you again.
Thanks, Rob.